Welcome to TheoTrade. This is Don Kaufman. You are watching the Theo Weekend Update for April 14th, 2018. Let's get started with just a brief recap of some of the action of this past week, and then I'm going to answer one of the undying questions. I get a lot of emails about this, a lot of chat inside of the TheoTrade chat room, and that question happens to be, hey Don, why are you so bearish? All right. We'll cover that here just momentarily. Let's get to a little bit of the update. First of all, we're going to talk a bit about the SPX. So the SPX on the week finishes higher, mildly higher. The S&P's tracked just about 50 points higher. Now, if you remember back from last week, we were riding on a pretty good expected move. Now, for those of you, again, that need a little update on expected move is really what the options market depicts risk to be. So the expected move on the week was just shy of about $70, which is a pretty good size range, right? So you're supposed to move either up $70 or down $70. Well, we actually hit the upper edge of that expected move, okay, reverberated right back inside of it, and even saw a little sell side activity coming into late Friday. So all in all, we stay inside of the expected move. But one thing that really surprised me, and this is moving forward into this next week of trade, we've actually got a rather tight expected move, okay, in comparison to any of the recent previous weeks. So we've seen some fairly wild volatility, obviously, that kicked off in February. Okay, on a week-to-week basis, we've seen anywhere from, a $65 expected move, like this past week was about 68. One of the lower expected moves recently was maybe 58. But this next week, so the coming week, we're sitting on right around about a $48 expected move, and that surprised me. It's relatively low, so volatility has contracted quite a bit. Again, I'll talk about that in a few minutes when we cruise over to the charts about some trading opportunities. Now, this past week in trade, really the only thing I was kind of looking forward to, number one, the FOMC minutes, which was totally lackluster. We knew he was going to be a little bit more hawkish. All right. So number two were some of the earnings that came out of the banks. This is big. So the XLF had a complete reversal on Friday morning. For those of you that don't necessarily watch intraday trade, we had Citigroup out with earnings and Wells Fargo and again, JP Morgan. They came out with earnings. The underlyings were trading higher in the pre-market, and then they sold off pretty dramatically throughout the course of Friday's session. A lot of people were pointing fingers on Friday, and they're like, okay, this is going to be risk coming into the weekend. It's going to be, Syria, and truthfully, that had nothing to do with some of the sell side activity. The sell side activity that was progressing really started in the financials, and I'll just give you an example of some of the financials, and really the results that they had were, again, initially you started looking at it, they're like, yeah, this is really impressive. But I'll give you one specific example, and I was talking about this a bit in the chat room yesterday. Maybe not everybody caught that, but here's one of the examples. So JP Morgan, in terms of assets under management, they have just over $2 trillion in assets under management. Now, the financial world, that's pretty much where I come from, right? And when you're looking at a financial firm, one of the things you always want to look at, and granted, JP Morgan has investment banking and they have mortgage and they have, divisions in trading. But one of the things that I'll often look at is the assets under management. That is, how much of, for instance, your capital are they managing? So they're just over about $2 trillion in assets under management, right? Neither here nor there. But the year-over-year growth was about 10%. Now that bothered me. And you're like, why? They got 10% more assets. Yes, but they're gathering assets, meaning they're actually going out and they have thousands and thousands of people trying to gather assets. That, for the most part, okay, these are people that call you up on the phone and like, please bring money to JP Morgan. So anyway, they gained about 10% year over year. The thing that bothered me, if you looked at the chart on the S&P, okay, the S&P in the exact same time frame was up right about 13.5%. So think about that for a second. Their assets under management, which are right around $2 trillion, they year over year appreciated by about what? About 10%, but the S&Ps are up over 13% in that exact same time frame, which means that the assets they're managing are really not doing very well, or many of their clientele are starting to contract capital, which is actually going to bring me into a much bigger point here momentarily. But that's just one thing that really resonated with me in terms of the financials. I'm like, this is not good news. This is either, number one, they can't even manage the assets they have, right? Because they're trying to squeeze returns in a marketplace that became too efficient. Or number two, again, their asset gathering has gone downhill and they're actually starting to lose capital out there. Now, it's not good. Okay, the financials are in trouble. We're going to get more financials out with earnings coming into Monday. And I say this is not good. And with all due respect, the financials have had everything in the world going for them in the last 18 months. Right? They've had deregulation. They're still getting money thrown at them, okay, in terms of like cheap capital, and yet the interest rates started to appreciate, so their balance sheet should look better. Then they get the tax plan. I mean, we could spend an hour just talking about everything that's going right for financials, and they're still, on average on Friday, they were down between 2 and 3%. Okay, I'll come to that a little bit more in the charts momentarily. Now, bigger picture here. I get a lot of emails about this. I get, a tremendous number of chats, in our chat room on a day-to-day basis. Don, why so bearish? Now, I want to be clear about my bearish take in the marketplace. My bearish take isn't necessarily right here, right now. Let's not confuse trading, okay, and per se investing. So when I talk about investing, I'm talking about a horizon maybe more than 3 months, 6 months, a year out. And my longer duration, okay, is absolutely bearish. And that's where people start asking, well, okay, so why? Well, some of it has to do specifically with the financials, but let's look at the bigger picture, okay? And again, the bigger picture for me has a lot to do with the Fed. It has a lot to do with central bankers in general, okay? Bottom line, let's first talk about the U.S. Here in the U.S., okay, we are starting to raise interest rates. Now, as the interest rates start to go up, the cost of carry of many of trades that trading firms would use, and if you're not familiar with the term of cost of carry, it's really the cost of them being able to borrow money and being capable of trading with it. There are proprietary trading firms all over the place. Right? There are hedge funds out there. There are, again, market-making firms, and all of them have this cost of carry. And as the interest rates start to come up, their cost of carry increases, which means many of the types of trades that they're going to do, and again, this is actually even in the short term, the trades and the investments they're going to have to do, okay, they're going to change. They're going to have to contract capital because the cost of carry is going up, and a lot of their arbitrage strategies and so forth are no longer going to work. Now, that's going to have a drastic impact, not necessarily in bringing the market down per se, but it's going to increase the volatility, okay? And it's actually going to really impact liquidity of the market, not in a positive manner. So that's one of the aspects with interest rates going up. The next thing, we start to look at the FOMC, they're mopping up right now a $4.5 trillion balance sheet. And as they start to contract capital, okay, from the economy, clearly that is going to have an impact. So we're getting this, okay, let's bring rates up, and at the same time, let's pull the rug out of $4.5 trillion, right? Doesn't exactly bode well for the marketplace moving forward. But I don't want to stop there. I want to look at things like the ECB. European Central Bank with Mario Draghi. Right now, they're still buying, okay, bonds, and they've actually reduced their bond buying, which effectively what they're doing is they're going out and buying corporate bonds. They're out there and they're allowing, and again, bear with me here because this one's pretty shocking. They're allowing major corporations to finance things, right? Bonds. So they're giving them debt and they're giving them that paper at next to nothing. When I say giving them the paper, it basically means they're giving them an interest rate that's literally next to nothing. So you can get some really hideous, degenerate companies. Doesn't matter. Why? Because they get the money for next to nothing. Anyway, the ECB has reduced their bond buying right now. So are the rates going to start to go up? Are we going to find out who's the degenerate company and who's not? Then you got to look over, okay, at Japan. Total and complete debacle. Okay. First of all, the Bank of Japan owns 80% of the ETF market. So it's not even a free market anymore. Let's not even talk about the bonds, which are negative interest rate, right? So negative interest rate policy is still, it's the in thing still in Japan. And all of this kind of accumulated. Again, they're trying to get out of it. They're trying to mop it up. I still have not heard, okay, a positive scenario. How are they going to get out of all of this? How many decades may it take to pull us out of, for instance, negative interest rate? When you look at again, the ECB, they're allowing degenerate companies to borrow for next to nothing. How are you ever going to get interest rates back up? That's one of the things that I don't have any definitive answers for. And one of the things that makes me bearish in the marketplace, okay? People, all right, companies, everybody, they're hooked on the juice. The juice is low interest rates. And the moment those rates start to go up, okay, everything starts to maybe not look necessarily as rosy. Hence why I'm bearish. With that, let's go over to the charts.
All right, done with the bearish rant and on to the charts. Hey, people, you asked why I was bearish, and I tried to give you, part of it. And, again, we could spend hours talking about, some of the issues in the broader world economies out there. With that, though, as I said, kind of onto the charts, what you're looking at here happens to be the SPX. Again, a little difficult from time to time to see with all these lines drawn on here, but these are your expected moves. And of last week, this was kind of the central point. That was the start point for the week. And we saw the S&Ps kind of explode right to the upper edge of the expected move and kind of reverberate right back down off of it. But again, ending up inside of the expected move. Now, as that rally kind of ensued, they crushed volatility. So allow me to remind you again, when I was just mentioning a moment ago in the in kind of the video portion, is that we just came off of, this was a $68 expected move. Now we've now contracted to about a $48 expected move. People, that's dramatic. When you get like, 1/3 less volatility in a given week, but you really have to step back and ask yourself, whoa, are markets really less volatile? I mean, you're going to start to get some earnings, not to mention a few more of the banks are coming out Monday, but we're starting to kick off, things like, Netflix earnings coming up. All right. That thing is getting served up again on a platter on Monday. Nevertheless, we're in full earnings swing. So as I cruise back to the SPX, again, specifically in the SPX, the volatility is contracted. One other aspect that really comes into play in the SPX is that we're going to a primary expiration week. It's something to think about. What a primary expiration week simply means is that there's a Monday expiration this week. There's a Wednesday expiration. Okay. There's a Friday morning expiration and a Friday afternoon. Now, the reason I'm mentioning this is because people all the time, well, what would you rather trade? The Friday morning expiration or the Friday afternoon? I like the weeklies. I like the weeklies because they're PM settlement. I don't like this AM settlement. It's, far too ambiguous for me to really want to set it up. But again, if you take a quick glance, you'll see that the volatility has dropped quite substantially. We're on a $48 expected move. Next thing we're going to take a quick glance at over here happens to be none other than the Volatility Futures. The reason I'm looking at the Volatility Futures and kind of taking you through Vol Futures, let's go a little further out in time, is that, there's this terms like contango and backwardation. For the most part, what we've been seeing the last few weeks, okay, and it's really existed almost exclusively in time since, February, and that is the Volatility Futures themselves have been inverted. And what that effectively means, and again, I don't like to use the terms contango and backwardation because I find a lot of people get, confused. What this effectively means is the volatility skew since February, since the volatility kicked off, has looked like this. And that meant that short-term volatility maybe was at 21, longer duration volatility, okay, was down, maybe at like, 1950. So the volatility futures themselves were inverted. And what that indicates is risk is prevalent. The world is blowing up underneath us. And as we go further into the future, that risk was going to abate. Now that, again, is what we saw really since February. I mean, February 5th, the volatility futures inverted and they haven't really looked back, and February 5th was a big inversion. Now, if you take a look at volatility futures, I don't want you to read into this too much. There is a very mild okay, normalization of the volatility futures, but the 32-day vol futures are almost the same, meaning the volatility skew is flattened out. And where that leaves us as traders, you know, people are going to, well, we're headed up, we're headed down. Okay, the volatility futures right now have completely flattened out, which means even the professionals are looking at the market right now and going, ooh, I don't know. I mean, you just don't have a great feel when the volatility futures have completely flattened out. Now, I'm going to take a decent shot at this, and I think there's going to be some more sell-side activity inside of the XLF. I'm not even going to go beyond the XLF because I think the XLF has the capability and the size to pull the S&Ps down with it. So we're going to be looking very, very carefully at the financials early in the week because I think this is where some of the volatility is likely to come from in the broader market. So if you take a look, and again, I pointed this out on last weekend's video as well, but if you take a look, once again, volatility is quite elevated inside the financials to the tune of about 81 cents, which again, on a percentage basis, it's a big move for the XLF. The XLF already had a large move down 1.5%. Now, a 1.5% move inside of the financials is, well, the S&Ps, I got to tell you, they performed spectacularly on Friday in the face of the fact that the financials were down 1.5%. And what offset the losses of the financials was actually the energy sector, which brings up a couple of trades that I've had on recently. So I maintain a bearish position inside of the XLF. Okay, I'm using a deep in the money put. I am buying a deep in the money put to simulate being short stock in the XLF. I've also got positions, and again, I'll kind of recap everybody on this. I've got positions inside of several of the financials. So one is the XLF. The other one happens to be Morgan Stanley. That's something we've updated you guys on these videos time again. We are bearish in Morgan Stanley. Morgan Stanley does have its earnings coming out. Obviously, you know, I don't speak with the mouth. I speak with the positions that I've got on. So I've got a bearish position in Morgan Stanley. I've got a bearish position inside of the XLF. I've explained those in previous videos. Other bearish positions that are kind of playing out well right now. One of them happens to be in Boeing. We re-upped the short position inside of Boeing. Again, these are longer duration positions. I want to clarify and quantify. I've also got a position, okay, deep in the money puts on Boeing. We saw some pretty strong sell side activity inside of Boeing over there. You know, speaking of energy, which we did just a moment ago because energy was the bright side of the marketplace, ironically, this was only, you know, one of my only bullish positions in the marketplace. I did not specifically use the XLE. My bullish positions were taken in ExxonMobil. You'll notice I currently have no positions in ExxonMobil. The bullish positions that I used in ExxonMobil, I sold out of the money puts. The rally, I bought those puts back. Now, okay, with earnings facing us in just a few weeks here on ExxonMobil, I will look to reestablish some positions in ExxonMobil. Now, that is if and only if ExxonMobil comes right back down, you know, into this 73, maybe 72 handle. Some of you guys will remember that, again, I sold some puts over there looking for the energy sector to rally. We got that rally over there. So the volatility, people, it's been good to us, and that's exactly what you want. Now, let's look at the broader market and the S&Ps for just a moment and give you a couple of levels. Once again, I talk extensively about these levels on almost every evening video that I've been doing and the weekend videos. For those of you that are, again, a little bit newer here, let's identify a couple of levels. To the upside over here, we have 26.82 right smack in the middle. Okay, that's 26.26 to the downside. Okay, 25.75. Now, as this week and weeks, I should say, have now progressed, we have actually been trapped inside of these levels since, okay, mid to late March. And all we're doing right now is just pinging, literally pinging back and forth between levels inside of the S&P. If you guys will recall, for those of you that watched the Wednesday evening video, on the Wednesday evening video, I was looking for some sell-side activity as the week progressed. But one of the things that I even mentioned is I was kind of shocked that we did not touch during the course of the week the 26.82. Well, we got within, again, 1 point of 26.82. Literally, we got within 1 point of 26.82, came back off of it, you know, fast and furious over there. Now, everybody, again, they always want to like, okay, forward looking. Again, forward looking, what am I expecting? More volatility. I'm expecting more volatility. Now, we're in a period, we got a little bit of a lull. In this next week of trade, there's no way I would sell options premium. No way would I sell options premium. Why wouldn't I be a seller of options premium? Volatility contracted substantially. Does that mean I would go out and run out and buy straddles? No, because if we do rally, the volatility will again continue to see that contraction, and it'll really hurt the calls. Now, the one thing that I think that you've got an excellent week coming up for, okay, go back to the S&Ps for just a second. This is going to be, I believe, a great week on an intraday basis. For those of you that do trade in an intraday, why? Well, I'll get into the exact specifics of why. You're entering into a trade this week whereby the volatility, and this is specific for options, but the volatility in the options market has contracted and contracted quite substantially from the previous week. So what it's going to give you the opportunity to do, I mean, if you look at like Monday's expiration in the spiders, the volatility is down to like 12%, right? These options, they're trading for $1. These things are like a 50 delta trading for $1. And it's going to allow you on an intraday basis to not absorb catastrophic amounts of risk, to be able to get long and short. So intraday trade this week is going to be, again, quite spectacular from a standpoint of the volatility has contracted, and it's allowing us to take some cheap shots in a marketplace that, hey, people, this marketplace is still moving. Yeah, we saw a little bit of a contraction of volatility, but the marketplace is absolutely still moving. And if you want to quantify that, when I say the marketplace is still moving, I mean on a historical volatility level. You can actually throw in here, okay, historical volatility. So historical volatility, and I'll turn around and I'll actually knock this down, for example, to like any 10-day, average, hit apply, hit okay. And even though the volatility contracted, this is actual price movement in the marketplace. This is not the options market. We're moving at a rate, okay, and this is averaged over the last 10 days. This is historical volatility over 10 days, moving at a rate of almost 22%. Yet, if you look at like Monday's expiration, the volatility in the SPX is below 12%. So it is going to make it advantageous to buy options. However, that's buying options on an intraday level. So what do I really expect in the S&Ps? Okay, I expect much of the same out of the S&Ps in this coming week, and that is pinging back and forth between levels. I'm not going to hold back over here. Specifically, I've been looking for this 25.75 this past week, and I'm going to be looking for it again this week. The thing you have to recognize, yes, the volatility abated to a degree, but as I keep reiterating to people, we're one tweet away or one bad earnings announcement away from seeing markets, take back off to the downside. The buy the dip is completely dead. We've seen markets rally, and I want to zoom out for just a second. We've seen markets rally, okay? But this is not indicative. It's just the market rallying right now. It's not indicative of these like bearish, wild moves up that we saw even the previous week. I mean, the market right now is, again, chugging a little bit higher, but it's slow, it's painful. It just looks like we're waiting for the next bout of heavy sell side activity. And that, people, is where I will leave it this week. Thanks everybody for joining us here at TheoTrade. Have a wonderful weekend. Bye-bye.